Ever looked at a company's financial statements and wondered if they're, well, telling the whole story? I mean, are these numbers actually true? Today, we are pulling back the curtain on some of the trickiest parts of making sure those financial reports are reliable. We're diving deep into what auditors call specific areas of engagement, risk, and consideration. Think of it as, an auditor's ultimate obstacle course, the places where things can really go sideways if they're not handled with extreme care. It's where the rubber meets the road in the world of financial scrutiny.
Absolutely. And our mission today is to demystify these critical areas. We want to show you not just what they are, but why they pose significant risks. And crucially, how auditors navigate them to ensure financial integrity. You'll gain a true shortcut, really, to understanding the hidden complexities that underpin every financial report you might encounter. It can transform you from just a passive reader to a really informed insider.
Okay, let's unpack this then. Imagine you're trying to figure out if a company is genuinely healthy, stable, trustworthy. These aren't just dry, technical details, are they? These are the pressure points, the areas that demand a sharp eye, deep understanding, and sometimes, a bit of detective work from the professionals, the ones whose job it is to give us that independent stamp of approval. It's fundamental to trust and transparency in business.
It really is.
So let's kick things off with something that sounds straightforward, but I suspect is anything but compliance with laws and regulations. You'd think a company just has to follow the rules, right?
But when we talk about financial statements, it seems, well, more nuanced. What exactly do we mean by non-compliance in this specific context?
Right. At its core, non-compliance means either failing to do something the law requires or doing something the law explicitly forbids. Our source material defines it formally as an act of omission or commission. And it can be intentional or unintentional, but the key is it's always contrary to prevailing laws and regulations.
Okay, so it's about breaking the rules, basically. Exactly, but it's not just about, say, an individual employee making a mistake on their own time. This noncompliance is tied directly to the business. It can be committed by or in the name of the entity or on its behalf by those charged with governance, management, or employees. So whether it's the board, top execs, or even a line employee acting for the company, if it's done for or by the company, it counts.
And why does this matter to you, the person looking at these financial statements? I mean, what's the real impact?
Think about the ripple effect. Non-compliance isn't just a slap on the wrist or some minor technicality. It can mean hefty fines, potentially damaging lawsuits, or other serious consequences that could financially cripple an entity.
Right. Imagine a company facing a huge multi-million-dollar environmental fine for secretly polluting a river, a fine that was never disclosed. That directly impacts its reported financial health, doesn't it?
Yeah.
It could completely change your perception of its stability and, well, its future.
Precisely. It's about those hidden liabilities lurking beneath the surface. And what's fascinating here is understanding the layered responsibility when it comes to compliance. Management, and by that we mean the company's executives and those charged with governance, like the board, they're primarily responsible. It's their job to ensure the company's operations align with all applicable laws and regulations.
So that includes the obvious ones like tax laws, but also the broader stuff.
Yes, exactly. The laws directly affecting financial statements like tax, but also the broader regulatory framework, environmental rules, consumer protections, safety standards, you name it. It's their job to build the systems and, frankly, the culture to ensure adherence.
Okay, so that's management's job. Where does the auditor fit in?
The auditor's role is crucial, but it's also distinct. Their responsibility is to obtain reasonable assurance, not absolute, but reasonable, that the financial statements are free of material misstatement because of noncompliance.
Material misstatement, meaning big enough to matter.
Yes, big enough to potentially influence a user's decision. And this is a critical distinction. Auditors are not responsible for preventing noncompliance. That's management's job. And importantly, they can't be expected to detect all noncompliance. It's just not feasible.
Why not? Why can't they find everything?
Well, the further removed noncompliance is from the financial statements, meaning the less directly it impacts specific numbers or disclosures, the less likely an auditor is to stumble upon it.
That sounds incredibly difficult then. So given these inherent limitations, why is detecting all noncompliance so hard? Where are the blind spots, even for really meticulous auditors?
Yeah, it's tough. There are a few key reasons. First, there's just sheer complexity. Many laws and regulations related to a company's day-to-day operations, think obscure safety standards or local zoning ordinances. They don't directly affect the financial statements, and they aren't usually captured by the main financial reporting systems. An auditor isn't, a legal expert on every single operational law out there.
That makes sense. They can't be lawyers for everything. What else?
Second, non-compliance can be intentionally hidden. This is a big one. It might be concealed through collusion, where multiple people work together to deceive, or forgery, maybe deliberate failure to record transactions, or management override of controls, where top executives just bypass the system entirely, or even just intentional misrepresentations to the auditor.
Wow. So active deception.
Exactly. This is where the auditor's role really becomes almost like a detective. And finally, there's the fact that whether an act actually constitutes noncompliance is ultimately a legal determination, not an auditor's judgment.
Ah, okay. So the auditor identifies potential issues and their financial impact, but the final call on legality rests elsewhere.
Precisely. Only a court or regulatory body can make that final legal judgment. The auditor flags the risk and the potential financial consequences.
So faced with this minefield, how do auditors even begin to tackle it? What's in their toolkit? How do they start?
They start by building a map, essentially, of the regulatory landscape. Auditors need to gain an understanding of the legal and regulatory framework that applies to that specific company and its industry. And crucially, they also try to understand how the entity is complying with that framework. They're trying to grasp the rules of the game for that business and how the company claims to be playing by them.
Right. And then I gather they distinguish between things that hit the numbers directly versus indirectly.
Exactly. For laws that have a direct effect on the numbers, like tax laws or specific rules on how revenue is recognized, auditors gather sufficient appropriate audit evidence. They need solid proof that those material amounts and disclosures are correct.
Those are the clear-cut ones, the quantifiable impacts.
Yes. But then there are the laws with an indirect effect. These don't directly hit a financial line item, but they could have a fundamental effect on operations. Think serious environmental rules or health and safety standards.
So what do they do for those?
For those, auditors perform specific, more probing procedures. They'll inquire of management and those charged with governance about compliance. Basically, they ask them directly if they're following these rules. They also inspect correspondence with relevant licensing and regulatory authorities, looking for any warning letters, fines, or red flags from government bodies.
It's like finding a breadcrumb trail, maybe.
Yeah.
Something that wasn't supposed to be there.
That's a great analogy. A small clue in one area could lead to a big non-compliance issue elsewhere that translates into, well, significant financial pain down the road.
Okay, so what happens if they do find those breadcrumbs? If non-compliance is identified or even just suspected?
If those suspicions arise, the auditor has a clear set of escalation procedures. The first step is usually internal discussions. The auditor discusses the matter with management at least one level above the suspected parties, and when appropriate, those charged with governance, the board or audit committee.
So taking it up the chain of command.
Exactly. It ensures the issue is raised to those with the authority to actually address it. Now, if management or the board can't provide sufficient information and the potential financial effects could be substantial, the auditor might need to consult legal counsel.
The company's lawyers?
Possibly the company's legal counsel, yes, either in-house or external. But importantly, they might also consult their own legal counsel.
Ah, getting their own independent legal advice. That underscores the seriousness.
It really does. It highlights the serious nature of such findings and the need for specialized legal expertise. From there, the auditor has to assess the impact. How does this finding affect their overall risk assessment? What does it mean for the audit opinion they'll issue? And crucially, how does it affect the reliability of written management representations?
Meaning, can they still trust what management is telling them?
Precisely. A significant non-compliance issue could fundamentally alter their view of the company's risk profile, the type of audit opinion they can give, and their level of trust in management. In certain extreme circumstances, withdrawal from the engagement is a possibility. It's rare, but powerful.
When would that happen?
It only happens if permitted by applicable law, and if the auditor weighs factors like management just not responding, the specific legal framework and the nature, urgency, and pervasiveness of the noncompliance. It's the audit firm essentially saying, look, we can't work with you under these conditions anymore.
Let's make this concrete. You mentioned that HIPAA example earlier. Walk us through how that illustrates the indirect effect.
Okay, right. So imagine James, our auditor, is working with Healthy Healthcare, a company providing services for kids. This company must follow HIPAA, the Health Insurance Portability and Accountability Act. That includes really strict rules for protecting patient privacy, things like age, health background, very sensitive stuff.
Okay, privacy rules.
Yeah.
But that doesn't directly hit the balance sheet, does it?
Not directly, no. Patient privacy doesn't immediately affect the company's revenue or expenses on the face of the financial statements. However, if there's an unauthorized disclosure of this confidential information, it could result in a massive contingent liability.
How so?
Think lawsuits from affected patients or huge regulatory fines from the government agency overseeing HYPE. That's a potential future financial obligation.
Got it. A contingent liability.
Exactly. So James must inquire of management and the board about their HEPA compliance. He needs to ask the tough questions. And he must inspect any correspondence with the regulatory agency. Is there a history of warnings? Are there ongoing investigations? This shows perfectly how seemingly unrelated operational rules can have huge, hidden financial consequences that the auditor absolutely needs to consider.
Okay, so they find something. Who needs to know? How does reporting work?
Once non-compliance is identified, the auditor needs to figure out who to tell. Reporting to the board or other oversight bodies, like the audit committee, is paramount. If those charged with governance aren't involved in management themselves, the auditor communicates all non-compliance to them, unless it's clearly inconsequential, basically, trivial stuff.
And if it's serious, intentional and material?
If it appears intentional and material, it gets communicated as soon as practicable because of its gravity. Time is of the essence. Now, if management or even members of the board are involved in the non-compliance, well, that's tricky.
Right, you can't report it to the people involved.
Correct. The auditor reports the matter to the next higher level of authority at the entity, maybe a supervisory board, or if there is no higher level, the auditor might need to get legal advice on their options.
What about telling people outside the company? Investors,
Right.
regulators.
That's where confidentiality comes in. Ordinarily, auditors have a professional duty of confidentiality. Think of it like doctor-patient confidentiality, but for finances. Disclosure outside the entity is rare, but it is required in specific, legally mandated circumstances.
Like what?
For instance, in response to inquiries from an auditor to a predecessor auditor. So when a new auditor takes over, they can ask the old one. Also, in response to a court order, that's a direct legal mandate you can't ignore. And finally, in compliance with requirements for the audits of entities that receive federal financial assistance from a government agency, if you take federal money, there are often higher transparency strings attached.
Okay, specific legal exceptions.
Right.
But the ultimate impact for us reading the reports is on the auditor's opinion, right?
Absolutely. That auditor's report is your window into the truth about the company's financial health, warts and all. If the noncompliance has a material effect on the financial statements and hasn't been adequately reflected, maybe the potential fine isn't recorded or disclosed properly, the auditor will issue a qualified opinion or adverse opinion.
And that's a major red flag for me, the reader.
Huge red flag. It signals that the numbers presented are not entirely reliable due to this specific, serious issue. A qualified opinion says, mostly okay, except for this, while an adverse opinion says, these statements as a whole are not fairly presented.
What if the auditor just can't get enough evidence? They suspect something's wrong, but they can't nail it down.
If they're unable to obtain sufficient appropriate audit evidence about the noncompliance, maybe because management is stonewalling or records are missing, then a qualified opinion or a disclaimer of opinion should be expressed.
A disclaimer, what's that mean?
A disclaimer essentially says, we couldn't get enough information to form an opinion at all, so we're not expressing one. That uncertainty itself is directly communicated to you, the user. It tells you the auditor couldn't complete their job satisfactorily.
And the worst case scenario, if the client just refuses to accept a modified report.
If the client outright refuses to accept the auditor's modified report, the one with the qualified or adverse opinion or disclaimer, the auditor must withdraw from the engagement, and they have to notify the board or audit committee about why they're withdrawing. This is the ultimate breakdown of trust and usually signals very significant unresolvable problems within the company.
Okay, so we've covered the watchdogs trying to spot legal missteps. But what happens when the numbers themselves aren't so clear-cut? That brings us to our next challenge. The art and science, maybe, of accounting estimates. This sounds like a world ripe for genuine uncertainty and maybe, sometimes, manipulation.
You've hit the nail on the head. Accounting estimates are essentially financial numbers in a company's reports that have an inherent lack of precision. They're not exact figures
Why do they even exist? Why not just use exact numbers?
because, quite simply, sometimes you can't get precise data about past events quickly or cost effectively, or very often because the measurement depends heavily on uncertain future events. You can't just look up an exact number for everything that needs to go into financial statements.
Can you give some examples? What kind of things are we talking about?
Sure. Think about how much a company expects to lose on bad loans. That's the provision for expected credit losses. Or how much they'll eventually owe employees for retirement benefits years from now. Or maybe warranty obligations on products they've already sold. Even estimating the probability of loss from pending litigation, which we just touched on, or valuing complex assets like goodwill.
Goodwill being the intangible value, like brand reputation.
Exactly. Things like brand, customer relationships, stuff that's valuable but hard to pin down with a precise number. These often require an educated guess. They are estimates. And it's crucial to remember it's management's responsibility to identify the need for these estimates and then make reasonable ones to include in the financial statements.
But here's the rub, right? These educated guesses, that's exactly where management bias can creep in, isn't it? How does an auditor navigate that subjectivity?
Exactly. That's the inherent challenge. Accounting estimates are imprecise by nature and can be easily influenced by management judgment, and that judgment might involve unintentional bias or sometimes intentional management bias.
To make the numbers look better, perhaps.
Potentially. The more subjective the estimate, the greater the susceptibility to bias. For example, if a company is trying hard to hit an earnings target, management might be tempted to be overly optimistic about future revenues, or maybe overly pessimistic about potential losses to nudge the numbers in the desired direction. The degree of estimation uncertainty, how much an estimate could reasonably vary, also directly affects the risks. A highly uncertain estimate carries more risk of being wrong or potentially manipulated.
So how do auditors deal with this? How do they maintain skepticism?
This is precisely why auditors must maintain professional skepticism, especially when looking for potential management bias or fraud related to estimates. To do this effectively, they need to really understand the whole picture. Why is the estimate needed in the first place? What do the accounting rules actually say about it? What's the nature of the estimate itself? And importantly, what internal controls does management have in place? Things like how they oversee estimates, if they bring in specialists, how they use technology, and crucially, do they review how accurate their past estimates turned out to be?
Like looking at past weather forecasts.
Exactly. It's like looking at a previous forecast to see how accurate it was before trusting the next one. Auditors consider the outcome of previous accounting estimates to help them assess the risk in the current period. This historical perspective can reveal patterns. Maybe they're consistently accurate, or maybe they consistently lean one way.
And if it's super complex?
Because these estimates can be incredibly complex, think valuing exotic financial instruments, auditors often bring in engagement team members with specialized skills or knowledge, or sometimes they hire external specialists.
So auditors don't have to know everything themselves?
No, they can't. Sometimes they need an expert's expert to help them assess the risks or perform specific procedures, especially with complex models or valuations.
Okay, so once the auditor understands the landscape, how do they assess and then actually respond to the risks they see in these estimates?
They assess risk by looking at two components separately. Inherent risk, the risk of misstatement before considering any controls, and control risk, the risk that the company's internal controls won't prevent or detect a misstatement. They evaluate the level of estimation uncertainty. They look at how inherent risk factors like complexity or subjectivity impact the methods, assumptions, and data management used. They also scrutinize management's final point estimate, the actual number they put in the financials, and the related disclosures. And crucially, they determine if the estimate poses a significant risk.
Meaning, it's a really big deal if it's wrong or biased.
Exactly. A significant risk requires more audit attention. Responding to this risk means tailoring the audit procedures. The higher the assessed risk, the more persuasive the audit evidence needs to be. Auditors typically perform one or more of three main procedures in response.
What are those?
First, they might obtain evidence from events occurring after the financial statement date, but before the auditor's report is issued, then compare that subsequent information back to the original estimate.
Like seeing what actually happened.
Yes, like waiting a few months to see if an expected credit loss actually materialized or if a warranty claim came in. Second, they can test how management made the estimate. They dig into the process, the calculations, the underlying rationale. And third, they might develop the auditor's own point estimate or a range of reasonable estimates. This serves as an independent check.
And what about testing the company's controls around estimates?
Right. If their initial risk assessment assumed that internal controls around estimates were effective, they'll test those controls to confirm. If not, or if the controls are weak, they rely more heavily on substantive procedures to directly verify the numbers themselves.
Okay, let's dive deeper into testing how management made the estimate. What specific things are auditors examining when they do that?
They obtain evidence regarding three key components: the methods, the significant assumptions, and the data management used.
Methods first.
Methods refers to the measurement techniques. For example, using the Black-Scholes formula for stock option pricing. Auditors check if the calculations are accurate and if judgments related to complex modeling have been consistently applied year over year.
Okay, and significant assumptions.
These are the key judgments management makes based on available information. Things like expected interest rates, discount rates for future cash flows, or predictions about the outcome of future events. Auditors verify if these assumptions are consistent with each other, with industry trends, and crucially, if management has the intent and ability to carry out any actions related to those assumptions.
And the data.
Data is simply the information used in the estimate: quantities, historical prices, contractual terms, market data. Auditors assess its relevance, its reliability, where did it come from, and whether management has appropriately understood and interpreted it.
This feels like where the detective work really shines, spotting management bias. What are the red flags auditors are trained to look for here?
They're constantly on alert for indicators of potential bias. For instance, if management frequently changes its estimation methods or assumptions based on purely subjective assessments rather than objective changes in circumstances, that's a flag. Another big one is when management's assumptions consistently seem to yield estimates that are favorable to their objectives. If the numbers always seem to paint the rosier picture, regardless of the underlying economic reality, that raises questions. Or, similarly, if they show a clear pattern of either optimism or pessimism in selecting their final point estimate from a range of possibilities. It's about looking for those patterns, not just one-off instances. Consistent behavior is a strong signal.
And if they find these red flags or other issues?
If the auditor finds that management hasn't taken appropriate steps to support their estimate, or if bias seems likely, the auditor might request management to perform additional procedures or justify their position further. Or, as mentioned, the auditor might develop their own estimate as a comparison. And finding these issues could even indicate a control deficiency, meaning a weakness in the company's internal financial processes for creating estimates.
What about really complex estimates, the ones using sophisticated models?
Right. When estimates involve complex models, the kind that require specialized skills or rely on data that's hard to verify, auditors have additional layers of scrutiny. They look at whether the entity has validated the model's theoretical soundness and mathematical integrity. Basically, is the model itself suitable, and does the math actually work as intended?
Makes sense. Check the engine before you trust the car.
Exactly. They also check if appropriate change control policies and procedures exist. How are changes to the model managed and approved? This prevents unauthorized tweaking of the model to get a desired result. And finally, they consider whether management has the appropriate skills and knowledge to understand and use the model. Do they truly know what they're doing with it? Or are they just blindly plugging in numbers without fully comprehending the underlying mechanics and limitations?
You mentioned one of the auditor's responses is developing their own estimate or range. Tell me more about that. How does that work?
This is a really powerful tool. It's their independent check, formally defined as an amount or range of amounts developed by the auditor in evaluating management's point estimate. This range, or single point estimate, developed by the auditor must be supported by its own sufficient appropriate audit evidence and be deemed reasonable based on the auditor's independent evaluation.
How do they actually develop it?
They have a few options. They might use a different model entirely, perhaps a commercially available one, as a comparison to management's bespoke model. Or they might use management's model but plug in alternative assumptions or data based on their own research and judgment. Sometimes they even engage an external specialist, like an actuary or valuation expert, to develop and execute a model independently. It's all about having an independent benchmark, a way to cross-check management's numbers.
So when all the testing is done, how do auditors finally conclude if management's estimate is reasonable overall? And what's the consequence if it's not?
They perform an overall evaluation. They step back and look at everything. Was their initial risk assessment appropriate? Does management's handling of the estimate align with the accounting rules? And crucially, have they gathered enough strong evidence to support their conclusion? Importantly, both corroborative evidence that supports management and contradictory evidence that conflicts are considered audit evidence. They have to weigh all of it. This balanced view is key.
What if an estimate is just inherently very uncertain?
If an estimate has high estimation uncertainty or is deemed critical to the financial statements, its nature, its sensitivity to changes in assumptions might require more expensive disclosures in the footnotes, or it might warrant specific communication to the board or audit committee, highlighting the uncertainty and the judgments involved. Transparency is paramount here.
Okay, here's a key takeaway for you listening. What actually is a misstatement when it comes to estimates? If the auditor disagrees, what happens?
Great question. If an auditor concludes that management's estimate is unreasonable, or perhaps not developed in line with the accounting framework, the difference between the estimate recorded by management and the auditor's best estimate supported by the audit evidence is treated as a misstatement.
So the difference is the error.
Essentially, yes. Now, if the auditor develops a range of reasonable estimates and management's recorded estimate falls outside that range, the misstatement is the difference between the recorded estimate and the closest point within the auditor's reasonable range.
That's a critical concept. It shows how even these guesses get refined and potentially adjusted to ensure the final financial statements are reliable.
Absolutely. Let's bring this to life with that practical example, the allowance for doubtful accounts. This is a classic estimate.
Right, the estimate for how much of the money owed to the company, accounts receivable, they don't expect to collect.
Exactly. Auditors evaluate its reasonableness by discussing the methods management used. Maybe they aged the receivables and applied percentages, or maybe they used a percentage of total receivables. They scrutinize the percentages used and other relevant factors impacting the estimate, like the current economic climate or issues with specific large customers. These are the assumptions.
And the data.
They obtain current trial balance information and detailed receivable aging reports as data. They review the company's history of actual write-offs. They assess whether last year's allowance turned out to be adequate. They pay close attention to customer balances that are significantly past due, as these often require specific attention and potentially full write-off.
And bias is a big concern here.
Huge. Since this allowance directly impacts reported net income, a lower allowance means higher profit. And vice versa, management's estimates here are particularly susceptible to bias, especially if they're trying to meet earnings targets. This example perfectly highlights how subjective judgments and estimates directly impact a company's reported profitability, making it a prime area for careful auditor scrutiny.
All right, let's move on and untangle another complex web. Related party transactions. This sounds like where things can get really murky really fast, where personal and business interests might collide.
That's exactly the concern. Related parties include a reporting entity's affiliates, like subsidiaries or parent companies, its principal owners, its management team, and members of their immediate families. The fundamental issue here is that unless it's a very routine transaction, like paying a standard salary, it's virtually impossible to determine if a transaction would have occurred in exactly the same way, same price, same terms if the parties weren't related.
Meaning they aren't truly independent negotiators.
Precisely. These transactions are not considered to be an arm's-length transaction. They weren't necessarily negotiated by two independent parties acting solely in their own self-interest, each trying to get the best possible deal for themselves.
Yeah, I mean, if you're dealing with your brother-in-law's company or another business you secretly own, are you really going to haggle hard over the price? Or are you maybe just moving money around for other reasons?
That's the core issue, that lack of genuine back and forth you'd expect between two totally separate businesses. Because of this, the true economic substance of a related party transaction might be very different from its legal form.
And accounting rules care about substance over form.
Yes. Generally accepted accounting principles, GAAP, require disclosure of these transactions precisely because of this inherent potential for distortion or even manipulation. Transparency is key.
So what's the auditor's role here? It sounds critical.
It's significant, and it ties directly into fraud risk. Auditors are responsible for identifying any related party transactions they encounter during the audit. They also need to ensure these transactions are properly accounted for and adequately disclosed in the financial statement footnotes.
And the fraud link.
Crucially, understanding related party transactions and relationships is also directly relevant to the auditor's evaluation of fraud risk. This is a major aha moment for you, the listener. Fraud is often more easily committed through related parties.
Why is that?
Think about it. If you control or heavily influence both sides of a transaction, you can essentially dictate the terms. You could potentially use related parties to hide assets, artificially inflate revenues, siphon off funds, or mask underlying financial problems. It creates opportunities.
Okay, so identifying these is key for fraud detection. What are the auditor's main objectives then?
Their aims are threefold. First, to recognize fraud risk factors that specifically arise from related party relationships and transactions. Second, to conclude whether the financial statements achieve fair presentation, specifically considering how they might be affected by these relationships. And third, their overarching goal is to obtain sufficient appropriate audit evidence about whether related party transactions and relationships have been appropriately identified, accounted for, and disclosed. It's about ensuring transparency and honesty so you aren't left in the dark about these potentially non-market dealings.
How do they go about finding these things? It seems like companies might not always be forthcoming. What procedures do they use?
It requires a detailed investigative approach. It's like a deep dive into the company's internal network and external connections. First, they need to understand and evaluate the company's own process, including its internal controls for identifying, authorizing, approving, accounting for, and disclosing related party transactions. Does the company even have a good system for this?
Do they ask about potential conflicts?
Yes, they typically obtain a conflict of interest statement from the client, often required from key management and board members, and they evaluate its completeness and accuracy. They're looking for who has financial ties outside the company.
What about direct questions?
Absolutely. They make direct inquiries of management and others. They ask for the names of all known related parties, any changes from the prior year, background information on the nature of these relationships, like ownership structures, and details of any transactions. That includes transactions entered into, modified, or terminated during the period, the types, the amounts, and crucially, the stated business purposes.
Do they look at specific accounts?
Yes, they test balances of accounts related to affiliated entities, often ensuring the testing is done as of concurrent dates to avoid timing mismatches. They inquire about any unauthorized or unapproved related party transactions, or any exceptions granted to policies.
And they talk to the board.
They inquire with those charged with governance, the audit committee or board, about their understanding of significant related party transactions and any concerns they might have. They also review public filings, SEC reports, regulatory filings looking for disclosures about officers and directors holding positions in other businesses. This can uncover undisclosed connections.
What about digging into actual transactions?
They review material transactions throughout the year, especially significant investments or unusual deals, specifically looking for related party evidence. This involves examining bank confirmations, legal confirmations, meeting minutes, invoices, contracts, and other records. And they don't just look at the current year. They review prior year's audit documentation, or, if it's a new client, they inquire of the predecessor auditor to spot any recurring patterns or previously identified issues.
What's the impact on the auditor's report if they find issues here?
It can be significant. For instance, if management makes a specific assertion in the financial statements claiming a related party transaction was conducted on arm's length terms, meaning fair market terms, but the auditor believes that statement is unsubstantiated by evidence.
They can't prove it was a fair deal.
Right. If they can't get sufficient evidence to support that claim, the auditor will express a qualified or adverse opinion. This directly challenges the credibility of that part of the financial statements, telling you, the user, that there's significant doubt about the fairness of that specific transaction. Furthermore, auditors have to meticulously document all identified related parties and the nature of those relationships in their audit work papers. It creates a clear trail for review and future reference.
Okay, so when it comes to actually identifying and examining these transactions during the audit, how does the process start?
It often starts with a team discussion. The engagement team discusses the potential for material misstatement due to related party issues, and they share the names of known related parties among the staff working on the audit. Awareness is key. But beyond that initial planning, auditors remain constantly alert throughout the audit for specific red flags that might indicate an undisclosed related party transaction.
What are some of those telltale signs they watch out for?
There are several common ones, things like compensating balance arrangements, where, say, the company maintains an unusually high bank balance that seems to benefit a related party. Loan guarantees, where one related party guarantees the debt of another, are a major flag. Why would they do that unless related?
What about transaction timing or terms?
Yes. Unusual, non-recurring transactions, especially those happening near year-end, can be suspicious. They might be designed to meet reporting targets or manipulate results. And transactions based on terms that differ significantly from market terms are a huge red flag. Selling something for $1 when it's clearly worth much more, or vice versa. Finally, non-monetary exchanges, where assets are swapped without much or any cash changing hands, can be complex to value properly, and sometimes used to hide the true nature of a deal. These are the signs that might make an auditor say, something might be amiss here, triggering a deeper look.
And if they do find significant related party transactions that weren't initially obvious, what then?
If significant related party transactions are identified, auditors have specific follow-up procedures. They must inspect the underlying contracts or agreements. They need to evaluate the business rationale or sometimes the lack thereof. Does the stated business purpose make sense? Or does it suggest the transaction might have been entered into to engage in fraud? They check if the terms are consistent with management's explanations, and critically, if the transaction has been appropriately accounted for and disclosed according to GAAP. And they must obtain audit evidence that the transactions were appropriately authorized and approved, making sure they followed the company's own internal governance procedures.
Let's use that example you mentioned earlier, Doug and ABC Company. How does that illustrate the accounting and disclosure?
Right. So Doug owns 60% of ABC Company, making him a related party. ABC Company buys a building from Doug personally for $15 million. However, let's say the building's appraised fair market value is actually $40 million. This is clearly a related party transaction where the price is not arm's length.
So how should it be recorded and disclosed?
The auditor must verify that the transaction is recorded on ABC's books at the price paid, which is $15 million. That reflects the actual cash outlay.
Yeah.
But more importantly, the nature of this transaction, that it was with the principal owner and potentially not at fair market value, must be fully disclosed in the financial statement footnotes. That disclosure is vital for transparency. It allows you, the reader, to understand the unique nature of the deal and its potential implications, even though the accounting reflects the $15 million cost. It highlights where interests might not have been perfectly aligned with maximizing ABC's benefit alone.
Okay, that makes sense. But what happens in the really problematic scenario where the auditor finds related parties or transactions that management didn't disclose at all?
That's a serious situation. If the auditor identifies previously unidentified or undisclosed related parties or significant transactions, they have several immediate steps. First, they must promptly communicate that information to the rest of the audit engagement team. Everyone needs to be aware. Second, they request management to identify all transactions that the entity has had with these newly identified related parties. The scope might be broader than initially thought.
And they need to figure out why it wasn't disclosed, right?
Absolutely. They inquire why the entity's internal controls fail to enable the identification or disclosure of these relationships or transactions. This is crucial for assessing weaknesses in the company's control environment. Was it an oversight or something more? Then, they perform appropriate substantive procedures related to these newly identified parties and transactions, basically. They audit them thoroughly. They also have to reconsider the risk that other related parties or transactions might still be undiscovered, potentially broadening their search.
And if it looks intentional,
If management's non-disclosure appears intentional, the auditor must evaluate the implications for the audit as a whole. This leans heavily into potential fraud territory and raises serious questions about management's integrity, which could impact the entire audit approach and the auditor's reliance on management representations.
are there extra rules for public companies here?
Yes, for publicly traded companies or issuers, the PCAOB, Public Company Accounting Oversight Board, standards add extra layers of scrutiny. For each related party transaction that needs disclosure or is deemed a significant risk, auditors must determine whether any exceptions to the company's established policies and procedures were granted. They also need to evaluate the financial capability of the related parties, for instance. If a related party owes the company a significant amount, does it actually have the ability to pay it back? Or if they've guaranteed debt, can they honor that guarantee? And they perform procedures on intercompany account balances, even if the related entities have different fiscal year ends, to ensure a complete and accurate picture of the consolidated entity. This shows that extra layer of diligence required for public companies to protect investors.
Okay, our fourth critical area takes us into, well, the shadow of uncertainty.
Yeah.
Litigation claims and assessments. This is all about what a company might owe in the future because of lawsuits or other legal troubles, right? How do auditors even begin to get their arms around something that hasn't fully happened yet or might not happen at all?
It's definitely a challenge. The auditor's quest here is to seek evidence, sufficient, appropriate evidence regarding actual or potential litigation, claims, and assessments. They specifically focus on three critical points for each potential issue. First, the period in which the underlying cause for legal action occurred. Did the event that led to the potential lawsuit happen before or after the financial statement date? This affects timing.
Okay, when did the problem start? What's next?
Second, the degree of probability of an unfavorable outcome. Based on the available evidence, how likely is the company to actually lose this case or claim? Is it probable, reasonably possible, or remote?
And third,
Third, the amount or range of potential loss. If they do lose, how much could it realistically cost the company? Can they make a reasonable estimate, or is it just too uncertain? These three questions, timing, likelihood, and amount, are the core of what auditors are trying to answer to determine if a contingent liability needs to be recorded on the balance sheet or just disclosed in the footnotes.
how do they uncover these potential issues? What procedures do they use?
They use several key audit procedures. They start by directly asking management about any unrecorded contingencies related to litigation. Are there any quiet legal issues brewing that management knows about but hasn't formally documented yet? They also review correspondence and invoices from attorneys. Often, billing details or letters contain clues about ongoing legal actions or advice being sought.
What about taxes or board meetings?
Good point. They check IRS reports and tax returns for unsettled disagreements, which could indicate potential tax-related litigation. And reviewing minutes of board and stockholder meetings is crucial. These minutes often contain discussions about significant legal matters and strategies. Finally, and very significantly, they obtain two key documents: a formal letter sent directly to the company's attorney asking for their assessment, and also a management representation letter.
What's in the management representation letter?
In that letter, management formally confirms in writing that they have disclosed all known, actual, or possible litigation, claims, and assessments to the auditor as required by the accounting standards.
Now, here's a key point I picked up earlier, a pass key for you listening. Management is the primary source of information about these contingencies, right?
Absolutely correct. Management is responsible for identifying and accounting for contingencies. The letter that the auditor facilitates sending to the company's attorney is primarily designed to corroborate the information management has already provided to the auditor.
So it's not the auditor's first guess, it's a verification step. They ask management first, then check with the lawyer.
Exactly. It's a crucial verification step to ensure what management is telling them aligns with the legal team's independent professional assessment. The management representation letter serves as management's formal sign-off on the completeness of the information they provided.
Tell us more about that crucial attorney letter of inquiry. Why is it so important?
It's a cornerstone of auditing contingencies. When the auditor's initial procedures suggest there might be actual or potential litigation, claims, or assessments that could be material, they seek direct communication with the entity's external legal counsel. Sometimes, if significant legal work is handled in-house, they'll communicate directly with the internal general counsel as well.
And how does the process work? Who sends the letter?
This is key. The letter is prepared by management, outlining the situation as they understand it, but it is sent by the auditors directly to the attorneys. And critically, the attorney's response comes directly back to the auditor, not through management. This direct channel is vital to minimize the risk of management filtering or altering the information.
What if an auditor decides not to send a letter?
If the auditor decides not to seek direct communication with legal counsel, perhaps because the risk seems very low, they must document their reasons for that decision in their work papers.
And what if the client refuses to let the auditor talk to their lawyers?
That's a major red flag. A client's refusal to permit inquiry of their attorneys generally will result in the auditor issuing a disclaimer of opinion or even withdrawing from the audit altogether.
Why is it such a big deal?
Because it represents a significant limitation on the scope of the audit. The auditor is being prevented from obtaining essential corroborating evidence about potentially material liabilities. They simply can't complete their job properly under those circumstances.
Okay, assuming the letter goes out, what do the attorneys provide in their response?
Attorneys provide their evaluation of the litigation, claims, and assessments that they are aware of and handling for the company. Their response should be dated as close as possible to the date of the auditor's report to ensure the information is current. The response typically includes their professional opinion on the expected outcome of any lawsuit and the likely outcome of any liability, including court costs, to the extent they can form such opinions.
But there are limitations, right? Lawyers can't predict the future perfectly.
Exactly. Auditors understand there are inherent limitations. First, attorneys may limit their replies to matters to which they have given substantial attention. They aren't expected to comment on every minor legal query they might have touched briefly. Or they might limit it to matters considered material if that scope is agreed upon beforehand between the attorney, management, and the auditor.
And what about confidentiality?
All right. The second limitation is the confidentiality limitation. As we touched on, in some sensitive cases, it may be unwise from a legal strategy perspective for an attorney to disclose certain confidential information. The classic example is knowledge of a potential patent violation by the company. If disclosing that potential unasserted claim in the financial statements could immediately trigger a massive lawsuit from the patent holder, the attorney might, under specific professional guidelines, limit their response regarding that specific matter. It's a delicate balance.
What happens if an attorney just flat out refuses to respond about a significant matter they have been working on?
If an attorney refuses to respond to the letter of inquiry regarding a matter to which they have devoted substantial attention and where the potential financial impact could be material, this is generally considered a limitation in the scope of an independent auditor's examination.
And that impacts the audit opinion.
Yes. It's serious enough to preclude the auditor from issuing an unmodified opinion, that clean bill of health. Their ability to gather necessary independent corroborating evidence has been compromised by the attorney's refusal.
But what about those cases where even the attorneys genuinely just can't predict the outcome? Maybe the case is brand new or the legal principles are untested.
That happens. Sometimes attorneys genuinely can't form conclusions about the likely outcome due to inherent uncertainties. This is different from a refusal to respond. In such cases, if the auditor is satisfied that the financial statement disclosure adequately describes the situation and the uncertainty involved, making it clear to you, the user, that the outcome is unknown, then no modification to the opinion would be required.
So it's not a scope limitation if the uncertainty is real and properly disclosed.
Correct. It's treated as a factual uncertainty about the future, which, if appropriately disclosed in the footnotes, doesn't prevent a clean audit opinion. The key is adequate disclosure so users aren't misled.
Okay, so after the auditor gets all this evidence from management, from the attorney's letter, from meeting minutes, what are the final steps?
They perform concluding procedures. They analyze all the information gathered to determine if management has adequately accounted for and recorded any amounts that are considered probable and are reasonably estimable.
Those are the ones that actually show up as liabilities on the balance sheet.
Yes. If a loss is probable and the amount can be reasonably estimated, GAAP requires it to be accrued as a liability. The auditor also verifies that potential losses that are deemed probable but not reasonably estimable, or those that are only reasonably possible, not probable, are adequately disclosed in the footnotes.
So even if it's not on the balance sheet, users need to know about the risk.
Absolutely. This is all about ensuring transparency for you, the financial statement user, so you understand all potential financial exposures the company faces, even those that can't be precisely quantified or aren't likely enough to record yet.
You mentioned the source material includes a sample attorney letter. Can you give us a flavor of what's in that?
Sure. It's typically a very formal, carefully worded document. It usually starts by outlining the context of the audit and management's responsibility for financial reporting. It will list the specific pending or threatened litigation that management has identified, along with management's own description and evaluation of each case. The letter then specifically asks the attorney to corroborate this information or provide any differing views. Crucially, it also asks the attorney to comment on any unasserted claims or assessments, potential lawsuits that haven't been filed yet, but which the attorney knows might be coming based on events that have already occurred. It explicitly includes a consent from the client allowing the attorney to share this information with the auditor, and asks the attorney to confirm their understanding of their professional responsibility to advise the company on disclosure matters according to accounting standards. It's designed to be comprehensive and legally sound.
All right, our final critical area. And this one feels, well, perhaps the most existential for a company. Its ability to continue as a going concern. This isn't just about profits or losses for a quarter, is it? It's about whether the company has a viable future at all.
That's exactly right. Going concern assessment is all about evaluating whether there is substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time.
What counts as a reasonable period of time? Is it standardized?
It varies slightly depending on the accounting standards being used, but the time frame is generally around 1 year. For public companies in the U.S. following FASB rules, it's specifically 1 year after the date the financial statements are issued. For governmental entities following GSB, it's 1 year beyond the date of the financial statements, with a little extra wiggle room if doubt arises shortly after year end. For entities using other bases like cash or tax, it's typically also 1 year after the date the financial statements are issued. The core idea is consistent. Can the company realistically stay afloat for at least the next 12 months?
Okay, so what happens if the auditor does see signs that raise substantial doubt? What are the steps they have to take?
If conditions or events, when considered in the aggregate, raise that substantial doubt, the auditor has specific mandatory steps. First, they must obtain sufficient appropriate audit evidence by performing additional audit procedures. This includes considering any mitigating factors that management might point to. Second, they must critically evaluate management's plans to alleviate substantial doubt. Are these plans realistic? Are they achievable? Or are they just wishful thinking?
What else?
Third, based on that evaluation, they must conclude on whether there is substantial doubt remaining and also assess the appropriateness of the going concern basis of accounting. Should the company even be reporting its financials as if it will continue, or is liquidation more likely? And finally, they must consider the impact to the auditor's report based on their conclusion. How will they communicate this risk to users?
You mentioned auditors look for signs or conditions. Is there a way they categorize these red flags? I heard about a mnemonic.
Yes, there's a common mnemonic auditors use to help remember the categories of factors that might indicate substantial doubt. It's FINE. F-I-N-E. It's like a quick checklist for potential trouble.
Okay, break it down for us. What does F stand for?
F is for financial difficulties. These are often the most obvious signs. Things like the company defaulting on loans, being unable to pay preferred stock dividends, dividend arrearages, being denied normal trade credit by suppliers. Or maybe needing to restructure debt just to survive, failing to meet statutory capital requirements, struggling desperately to find new financing, or being forced to dispose of substantial assets just to raise cash. Clear indicators of financial distress.
Makes sense. What about I?
I is for internal matters. These are problems originating within the company's operations. Think recurrent work stoppages or significant labor difficulties. Maybe becoming overly reliant on the success of just one particular project that suddenly goes south, or getting locked into uneconomic long-term commitments that drain resources, or having to undertake significant operational revisions or restructurings because the current model isn't working. Internal weaknesses.
Okay, F for financial, I for internal. What's N?
N represents negative trends. This is about looking at patterns over time. Things like recurrent operating losses year after year, persistent working capital deficiencies, meaning not enough short-term assets to cover short-term liabilities, consistently negative cash flows from operations, which means the core business isn't generating cash, or adverse key financial ratios that clearly signal a deteriorating financial position compared to peers or prior periods, downward spirals.
And finally, E.
E is for external matters. These are significant events happening outside the company's direct control that could threaten its viability. Examples include major legal proceedings that could result in crippling damages or injunctions. Maybe new legislation or regulations that could make its business model obsolete or much more expensive. Losing a key franchise, license, or patent that's essential to its operations, the loss of a principal customer or supplier that it heavily depends on, or even uninsured or underinsured natural disasters that devastate its facilities or markets, things from the outside world hitting the company hard.
That FINE mnemonic seems like a really useful framework for auditors to systematically think through all the potential warning signs.
It is. It helps ensure they consider a broad range of indicators. Now, when substantial doubt does exist based on these factors, auditors have to closely scrutinize management's plans for dealing with the situation.
What kind of plans are we talking about?
Management might propose various actions. Common ones include plans to borrow money or restructure debt, to improve liquidity or extend payment terms. They might have plans to sell assets, maybe non-core assets or even core ones if necessary to raise cash, or plans to delay or reduce expenditures, cutting costs, R&D, or capital projects to conserve resources. And sometimes, plans to increase ownership equity, perhaps by convincing existing owners to inject more capital or finding new investors.
But just having a plan isn't enough, is it?
Absolutely not. This is a critical point. Evaluating these mitigating factors must include assessing both management's intent to carry out the plans and their ability to actually do so. A plan to sell assets is meaningless without a likely buyer and a realistic price. A plan to borrow money is just a wish without a committed lender. Intent and ability are both essential for the plan to be considered a credible mitigating factor.
And even if the plans seem credible and alleviate the doubt, does the initial problem just disappear from the report?
Not necessarily. Even if the auditor concludes that management's plans do alleviate the substantial doubt, they still need to consider the need for adequate disclosure in the financial statements about the principal conditions or events that initially caused the doubt, and management's plans to deal with them. Transparency remains key. Even if the immediate storm appears to have passed, users need to understand the company's past vulnerabilities and the significant actions it had to take.
So how does this ultimately get communicated in the auditor's report? You mentioned it differs for private versus public companies.
Yes, the reporting requirements vary. Let's start with non-issuers or private companies. If substantial doubt was raised but subsequently alleviated by management's plans, and the disclosures about the situation are adequate, the auditor may, it's optional, include an emphasis of matter paragraph in their report. This paragraph would simply refer the reader to management's detailed disclosures in the footnotes.
But what if the doubt isn't alleviated, if it still remains?
If substantial doubt remains even after considering management's plans, then for a non-issuer, a required separate section must be added to the auditor's report. This section has a specific heading: Substantial doubt about the entity's ability to continue as a going concern. It can't be buried.
That sounds like a very direct warning. What does it typically say?
It's quite explicit. The wording often goes something like this: The accompanying financial statements have been prepared assuming that the company will continue as a going concern. As discussed in Note X to the financial statements, the company has suffered recurring losses from operations or list other specific conditions, has a net capital deficiency, and has stated that substantial doubt exists about the company's ability to continue as a going concern. It continues. Management's evaluation of the events and conditions and management's plans regarding these matters are also described in Note X. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. Our opinion is not modified with respect to this matter.
So it highlights the problem, points to the details in the notes, states the financials don't reflect a potential collapse, but doesn't necessarily change the main audit opinion itself.
Often, yes. If the disclosures are adequate, the opinion itself might remain unmodified. But this separate section serves as that critical alert about the going concern uncertainty. It tells you, the reader, exactly what the auditor found and directs you to where management explains its side of the story and its plans.
How does it work for public companies, the issuers?
For issuers, if there's substantial doubt about the ability to continue as a going concern, the auditor is required to add an explanatory paragraph to their report. This paragraph must include the specific terms substantial doubt and going concern. It serves a similar purpose to the separate section for non-issuers highlighting the uncertainty. Interestingly, while the general rule is to add this explanatory paragraph, auditing standards for issuers also allow auditors, based on their professional judgment in particularly severe circumstances, to choose to issue a disclaimer of opinion due solely to the going concern uncertainty.
Wow, disclaiming the whole opinion just because of going concern risk.
It's a very serious step, yes. It signals extreme concern and essentially tells investors that the level of uncertainty about the company's future viability is so profound that the auditor cannot provide any assurance on the financial statements overall.
Makes sense. What about documentation? What do auditors need to write down when these issues arise?
When substantial doubt exists, whether alleviated or not, auditors have stringent documentation requirements. They must document: 1. The specific conditions or events that initially caused them to believe substantial doubt existed. 2. Any significant mitigating factors they considered, including management's plans. 3. The audit work they performed to evaluate management's plans. This includes obtaining written representations from management describing their plans, stating the probability they believe the plans can be effectively implemented, and confirming that all relevant matters regarding going concern have been disclosed. 4. The auditor's conclusion about whether substantial doubt remains or has been alleviated. And 5. The effect of their conclusion on their evaluation of the financial statements, the adequacy of the disclosures, and the resulting audit report language. This meticulous documentation provides a clear audit trail supporting their professional judgment.
Are there any other wrinkles with going concern reporting? What if disclosures are bad or management won't cooperate?
Yes, a few other important considerations. If, in the auditor's judgment, the company's disclosures about the going concern uncertainty are inadequate, they aren't telling the full story that's considered a departure from GAAP. This would likely lead to a qualified or adverse opinion, not just an emphasis paragraph.
What if management just refuses to do the assessment?
If management is unwilling to perform or extend its evaluation of going concern when required by the circumstances, the auditor should also issue a qualified or adverse opinion because management isn't fulfilling its responsibilities.
And what if the company shouldn't even be using the going concern basis?
Right. If the financial statements have been prepared using the going concern basis of accounting, assuming continuity, but the auditor concludes, based on their work, that this basis is actually inappropriate, perhaps liquidation is imminent and unavoidable, then the auditor should express an adverse opinion.
Meaning the whole premise of the financial statements is wrong.
Exactly. It means the company shouldn't be reporting as if it will continue operating normally. Liquidation accounting might be more appropriate. Also, if an auditor expressed doubt in the prior year, but that doubt is removed in the current year, the prior period's going concern paragraph or section doesn't need to be repeated in comparative financial statements. And finally, it's crucial to note, going concern issues, whether resolved or ongoing, must always be communicated by the auditor to those charged with governance, the board or audit committee, ensuring they are fully aware of the assessment and the underlying risks. #, outro.
Wow. Okay. From the subtle dance of legal compliance and all the detective work involved there to the high-stakes game of estimating the future and assessing a company's very survival, we've really navigated a complex landscape today. We've covered non-compliance with laws, the precision needed for accounting estimates, the tangled web of related parties, the shadow of litigation risk, and that truly existential question of going concern. These are definitely the auditor's tough challenges.
Absolutely. And hopefully you now have a much deeper understanding of the meticulous and sometimes really challenging work that goes into financial audits. More importantly, you understand why these specific areas are so critical for assessing a company's true financial health and stability. This knowledge helps you become a much more informed observer of the business world. It lets you read between the lines of those financial reports and start to appreciate the underlying risks and sometimes the hidden complexities.
So, what does this all mean looking forward? As the world keeps getting faster, more complex, new technologies, new business models popping up all the time, consider this. What might be the next surprise area of risk for auditors? How might something like, say, artificial intelligence or maybe quantum computing down the line change how these kinds of deep dives are conducted in the future, especially in areas like estimating probabilities for litigation or estimates, or maybe identifying hidden related party relationships through massive data analysis? Definitely something to mull over as you encounter financial statements from now on. Well, that's all the time we have for this deep dive. Until next time, keep learning, keep questioning, and keep exploring the fascinating world around us.